What if the biggest housing crashes in history weren't really about reckless homebuyers or greedy banks? Or even low interest rates? What if the real trigger was something far more political, far more hidden, and far more dangerous? Government debt. Here's the mystery. Again and again, across countries and decades, housing bubbles explode right when governments are drowning in debt. Then, when the bubble pops, the debt doesn't disappear, it gets worse. Is this just coincidence? Or is housing secretly being used as a pressure valve for government finances? Tonight, we're pulling on that thread. Housing feels personal. It's about shelter, family, stability. Government debt feels abstract numbers on a spreadsheet, debated by economists and politicians. But modern financial systems quietly connect the two. Governments borrow heavily to fund wars, welfare states, stimulus programs, and political promises. As debt rises, they face a problem: how to keep borrowing cheap without triggering a crisis. The solution, again and again, has been the same: lower interest rates, easy credit, expanding mortgages. Because when housing booms, it creates the illusion of prosperity, rising home values, happy voters, growing tax revenue, and calm bond markets. Everyone feels richer. The cycle usually starts quietly. Government debt climbs after a shock war, recession, financial crisis. To prevent panic, central banks step in. Rates fall, lending standards loosen. Mortgages become easier than ever. At first, this looks harmless, even helpful. Lower rates mean cheaper monthly payments. More people can buy homes. Construction accelerates. Jobs grow. Politicians celebrate affordable housing. Banks celebrate rising loan volumes. Households celebrate paper wealth. But underneath, something dangerous is forming. Housing isn't rising because incomes are growing. It's rising because debt is growing. Ask why. As prices climb, governments benefit in three powerful ways. First, rising home values increase tax revenue, property taxes, transaction taxes, capital gains. Second, homeowners borrow against rising equity, boosting consumption and economic growth. Third, booming housing markets stabilize banks, which hold government bonds. This creates a feedback loop. Higher debt gives lower rates, gives housing boom, gives political stability, gives more debt. The bubble doesn't feel like a bubble. It feels like policy success. And that's why warning signs are ignored. Eventually, math reasserts itself. House prices outrun wages. Mortgage payments stretch households thin. Even small rate increases cause stress. Then something breaks: an inflation spike, a rate hike, a recession. Housing demand freezes. Prices stall. Then fall. And suddenly, the debt that was hidden inside rising home values becomes visible. Defaults rise. Banks wobble. Construction collapses. Tax revenue evaporates, just as governments need money the most. The housing bubble didn't cause the debt crisis. T revealed it. Here's the cruel twist. When housing crashes, governments step in to save the system. Banks are bailed out, mortgages are guaranteed. Stimulus spending explodes, private debt becomes public debt. This is exactly what happened after the 2008 financial crisis. Housing collapsed. Governments borrowed trillions to prevent total failure. Debt to GDP ratios soared while homeownership became harder than ever. The public paid twice, once during the boom through inflated prices, and again during the bust through taxes and austerity.